The stock for Buru Inc., trading under the ticker BURU, closed its last market session at a price of $0.20 per share on Friday, November 21, 2025. This price action, coming off a low trading range, is part of a longer, highly volatile pattern that defines this stock. Now, what's crucial to understand immediately is that the market narrative, which has largely focused on the company's precarious financial position and its initial rocky transition from industrial blue lasers to defense technology, is potentially missing the forest for the trees. The unexpected insight here is not the financial distress that's priced in, but the speed and determination of its pivot into defense, which has been accelerating through a series of tactical agreements and acquisitions. This aggressive strategic shift is the reality that is clashing with the common expectation of slow, painful, and ultimately futile corporate restructuring, and it's what has been driving the extreme volatility and spikes in volume we've seen recently. The general belief among many retail investors and casual observers, especially those who came into the stock during its SPAC period or its initial listing, is that Buru is a highly speculative, distressed asset, a laser technology company that failed to gain commercial traction and is now scrambling for relevance. The persistent sub-dollar share price and the NYSE non-compliance notice regarding stockholders' equity, which it received in May 2025, certainly lend credence to this bearish view. However, a deeper look at the past few months reveals a company that is not just treading water, but is aggressively executing a complex, multi-layered transformation plan. In October and November 2025 alone, we saw announcements about the completion of the first phase of the Orbit acquisition, advancing its software-driven defense and security platform, and the execution of the first tranche of a strategic financial program with TecneSiAP, an Italian defense contractor. These aren't just press releases. These are concrete steps that are fundamentally reshaping the company's business model from a pure-play industrial laser manufacturer to a defense and security technology integrator. The expectation is that management is fumbling. The reality is that they are rapidly assembling a new corporate structure via M&A and strategic alliances. And this tension is why the stock chart looks less like a smooth trend and more like a heart rate monitor. Looking at the most recent stock movement, the stock has been extremely active. While the closing price on Friday was $0.20, the intraday range was significant, and we saw a steep decline in pre-market trading on the 21st, which was attributed to market concerns over partnership restructuring and a delayed earnings release. This kind of double-digit percentage decline and subsequent clawback attempts shows the immediate, visceral reaction of a highly speculative float to any news, positive or negative. The average volume, currently around 43 million shares, is astronomical for a microcap stock, signaling an intense tug-of-war between buyers betting on the successful execution of the defense pivot and sellers capitalizing on short-term fear or simply exiting a long-term distressed position. When you see daily volume hitting the tens of millions for a company with an $88 million market cap, it's a clear sign that a profound structural change is either happening or failing in real time. Institutional ownership is currently low, below 1%, but what's interesting is the activity within that small pool. Recent 13F filings show some major increases in positions from firms like UBS Group AG and Vanguard Group, even in the third quarter of 2025, suggesting that a small number of sophisticated players are taking a calculated risk, accumulating shares at these depressed prices, which is a key institutional endorsement that counters the general distressed asset narrative. This highly concentrated institutional buying is an expectation buster, a signal that smart money sees a path to compliance and growth where the consensus sees only failure. To understand the core business, Buru is primarily known for its high-power blue laser technology. Blue lasers are uniquely effective for processing highly reflective and difficult-to-weld materials like copper and aluminum, which are critical in electric vehicle battery manufacturing and specialized aerospace applications. The original business model was centered on selling these laser systems for industrial purposes. However, the pivot we've discussed involves leveraging this laser technology and the underlying engineering expertise toward defense and security applications. This includes their planned joint venture with Maddox Defense for unmanned aerial systems, drones, and the integration of Orbit's operational resilience software. The vision is to move from a capital equipment seller to a comprehensive, technology-driven defense contractor whose offerings are vertically integrated from hardware to mission-critical software. The challenge, and the reason for the low share price, is that the commercialization of the blue laser technology has been slow and capital-intensive, leading to sustained operating losses and negative cash flow. Older reports consistently highlighted the capital constraints and the difficulty of scaling in the traditional industrial sector, which is precisely why the defense pivot, with its higher-margin government contracts and strategic alliances, is so critical to the company's survival. Now, let's talk about the elephant in the room: short-selling activity. Given the stock's low price and history of financial difficulty, it's a prime target for short sellers, and the data confirms this. Short interest as a percentage of float, while not astronomical enough to signal an immediate, guaranteed short squeeze, is notable at around 4.8%. More telling, however, are the spikes in the borrow cost rate and the daily short volume, which is often much higher than the reported short interest would suggest, implying heavy short selling on a day-to-day basis. The short thesis is straightforward. The company is burning cash, its historical business is struggling, and the massive, complex defense pivot is a Hail Mary pass that is highly dilutive and may never secure the required government approvals or market adoption, especially given the Italian Golden Power review that is a condition of the Tecne deal. Hedge funds and institutions that take a short position here, often anonymously via put options or through smaller prime brokers, are essentially betting that the intrinsic value is zero or near zero, and that the company will continue to raise capital through highly dilutive offerings that crush the stock price. This is a classic distressed debt equity short play. For the retail investor, this awareness is actionable and essential. First, you need to know where to look for the data. Resources like Fintel or your brokerage platform can provide the days-to-cover ratio, which is the short interest divided by the average daily trading volume. Currently, a high-volume stock like Buru will have a low days-to-cover, meaning it would be easier for short sellers to cover their positions, which lessens the immediate pressure for a squeeze. Second, monitor borrow cost spikes. If the cost to borrow shares suddenly jumps, it's a direct signal that demand from short sellers is overwhelming supply, often preceding a small pop in the stock price. To react responsibly, you must remain factual. The underlying short thesis is valid because the company is high risk. Resist the online hype, often seen on forums and social media, calling for an immediate coordinated squeeze. Instead, use the short interest as a proxy for market skepticism and as a gauge of potential volatility. A coordinated short attack, often accompanied by specific, detailed short reports, should be met with an objective look at the company's recent press releases and SEC filings. What should you monitor next week? The key signal will be the progress on the corporate transformation. Specifically, look for updates on the network contract with Tecne, which is targeted for finalization by the end of November, and any new filings related to the Orbit acquisition or the planned joint venture with Maddox. These are the catalysts that directly challenge the short thesis. If the company successfully executes these steps, it provides concrete proof of concept and a new, more sustainable revenue stream, which could trigger a rapid repricing of the stock. Conversely, a delay or failure in any of these initiatives will justify the short seller's skepticism and likely lead to another leg down. The price action here is tied directly to legal and commercial execution, not sentiment. The future outlook for Buru is one of extreme outcomes. The bull case rests entirely on the successful transformation into a defense tech company that can tap into high-margin government contracts, especially in the European and U.S. markets, through its new partnerships. This would see the stock move well beyond its current penny status as it regains NYSE compliance by substantially increasing its assets and equity base. The opportunity is an asymmetrical bet. A small investment today could yield significant returns if the pivot works. The risks, however, are just as pronounced. The failure of the Techna deal due to regulatory hurdles like the Golden Power review, the inability to scale the Orbit software platform into the defense sector, or a continued need for highly dilutive financing that keeps the share count ballooning. This all circles back to the tension between expectation and reality. The expectation is that an industrial laser company cannot pull off a complete defense tech corporate restructuring. The reality is that the management team is moving at lightning speed, signing agreements and completing acquisitions that are changing the company's